Folks, I want to level with you tonight, and I hope you really listen because what I am about to say is not about fear. It is about arithmetic and common sense. I am not losing sleep because I own gold. I do not. I am losing sleep because millions of perfectly decent, hard-working people are piling into something they barely understand at prices that simply do not make sense. And when that kind of stampede happens, history tells you the ending long before the last buyer walks in the door. Right now, as I speak, gold is hovering around $4,000 an ounce. Just a few weeks ago, it hit a record near $4,379. That is roughly a 60% jump in a single year. The television talking heads are calling it the new core holding, the must-have hedge, the ultimate portfolio anchor. Big banks, the likes of J.P. Morgan, Goldman Sachs, Deutsche Bank, are publishing glossy reports explaining why $5,000 an ounce is almost inevitable, maybe even conservative. Central banks have joined the chorus. They have scooped up more than 900 tons of gold in 2025 alone, on top of record buying in 2024. If you only looked at price charts, headlines, and sound bites, you might think gold had suddenly discovered a new law of physics, one where it levitates forever. But markets never discover new laws of physics. They only forget old ones. What nobody is bothering to shout over the noise is simple. We have seen this film twice already, and both times it ended with wreckage. In 1980, gold soared to $850 an ounce. Adjusted for inflation, that is roughly $3,200 in today's money. Within 2 years, it had fallen 65%. In 2011, after running to $1,900 an ounce on post-crisis panic, gold slid 45% over the next 4 years. People who bought at the top in either episode spent decades staring at losses, convincing themselves that someday the world would finally recognize their brilliance. Now, here we are again, gold above 4,000, pundits promising the sun and the moon, social media feeds filled with charts pointing from the bottom left to the upper right. The fear trade, as they like to call it, has reached a fever pitch. And when fear itself becomes the consensus, that is the precise moment when the smart money starts looking for the exits. Let me share something. My teacher Ben Graham taught me nearly 70 years ago, a sentence that has made me more money than any price forecast from any Wall Street firm. Price is what you pay, value is what you get. Gold has a price. It does not have intrinsic value in the sense that a productive asset does. It does not send you a dividend. It does not grow crops. It does not invent a better phone. It does not cure disease. It does not employ anybody after it has been mined. It just sits there, mute, unchanging, and utterly indifferent to your hopes. Imagine you buy a farm in Iowa. Every year that farm yields corn and soybeans. Those crops can be sold, and the cash they bring can be reinvested or spent. The land itself can become more productive over time with better seeds, better machinery, better methods. Imagine you buy a share of Coca-Cola. You own a sliver of a business that sells billions of beverages every day, earns real profits, and sends those profits out to shareholders or uses them to grow. Imagine you buy a U.S. Treasury bill. The government promises to pay you interest on a schedule and return your principal at maturity. Now imagine you buy 1 ounce of gold. In 10 years, if you have not sold it, you will still have 1 ounce of gold. It will not have given you a single dollar of income. It will not have grown bigger. It will not have improved. You may hope that someone will come along and pay you more for it, but that is not value. That is expectation. Let me give you a picture that has helped me think clearly about this for many years. If you gathered together every ounce of gold ever mined in human history, every wedding ring, every coin, every bar stacked in vaults from New York to Zurich to Shanghai, and melted it down, you would get a cube of metal about 68 feet on each side. It would comfortably fit on a baseball infield, At today's prices, that cube would be worth around $19 trillion. Now ask yourself a simple, perhaps childish question. If I gave you a choice between that $19 trillion worth of inert metal and an alternative of equal price, what would you choose? For the same $19 trillion, you could buy every acre of farmland in the United States, about 400 million acres, which together produce more than $200 billion in crops every year. You could also buy the 20 most profitable companies in America, businesses that earn hundreds of billions of dollars annually in combined profits, and you would still have trillions of dollars left over to leave as cash. On one side of the scale, you have a giant glittering cube that produces nothing, hires no one, pays no dividends, grows not at all, and depends entirely on the willingness of the next buyer. On the other, you have farmland, factories, brands, software, patents, and human ingenuity grinding away day and night to create value. Anyone observing this from Mars would have trouble understanding why the cube gets so much love during certain years. So why is the cube being worshipped in 2025? Not because the metal suddenly discovered new uses or because some technological breakthrough changed its economics. Gold is up because people are scared. Scared of inflation, even though inflation has been easing from the peaks we saw in 2022. Scared of geopolitical turmoil, even though our species has rarely known a truly quiet decade. Scared of central bank money printing, even as the Federal Reserve has spent the last couple of years raising rates and shrinking its balance sheet. Fear can push prices far beyond reason. It can do so quietly, one nervous buyer at a time, and then all at once when television hosts and social media stars start chanting the same lines. Look at the numbers coming from the World Gold Council. Investment demand, not jewelry or industrial use, has driven this latest surge. Exchange-traded funds that hold nothing but gold bars in vaults have seen their holdings jump. Futures traders on major exchanges are more aggressively long than they have ever been. Central banks, which were big buyers when gold prices were far lower, have begun to slow their purchases as the cost climbs, but few people bother to read the small print. The pattern is familiar. Prices rise much faster than any plausible fundamental justification. Sentiment shifts from maybe this makes sense to only a fool would stay out. Then comes the story. Every bubble has its story. This time, the story goes like this. De-dollarization is inevitable, global debt is unpayable, supply chains are fragmenting, and the only safe place left is gold. Those are serious topics, but they are being bundled together into a slogan, "This time is different." If you study financial history, you eventually come to dread those four words. When people start waving away valuation and saying that this time is different, it usually means the same old script is playing out again. I heard it in the nifty 50 years of the 1,970 seconds, in Japanese stocks in 1989, in tech stocks in 1999, in housing in 2006, in cryptocurrencies not so long ago. Now I hear it again around gold. Let me take you back to 1,980 for a moment. Gold climbed from about $100 an ounce in 1976 to $850 by January 1980%, a 750% gain in 4 years. Inflation in the United States was running above 13%. The Hunt brothers were trying to corner the silver market. People lined up to buy Krugerrands. Cocktail party conversations revolved around how high gold might go, $2,000, $3,000, perhaps even $5,000 an ounce. Then came Paul Volcker at the Federal Reserve. He did something that would be almost unthinkable today. He raised short-term interest rates to around 20%, not 2%, not 5%. 20. It was painful. It caused a brutal recession. It also broke inflation's grip. Once inflation expectations cracked, gold lost its magic. By 1982, the the price had fallen below $300 an ounce. The drop from peak to trough was around 65%. Investors who bought near the top waited almost 3 decades just to see the nominal price get back to where it had been, and even then, inflation had stolen a big chunk of their purchasing power. Fast forward to 2011, the world was still shaken from the financial crisis. Central banks had cut rates to zero and launched quantitative easing. Newspapers carried headlines about Greek defaults and European banking contagion. Gold, which had traded around $700 an ounce in 2008, climbed to about $1,900 by September 2011. Once again, the forecast mills switched into overdrive. We heard that the dollar was doomed, that hyperinflation was just around the corner, that gold was the only real money left. What actually happened? The system bent, but it did not break. Central banks eventually began tightening. Banks rebuilt their capital. Inflation never exploded into the double digits. And gold, having overshot, spent 4 years falling. By late 2015, it was trading around $1,050 an ounce, roughly a 45% decline from the peak. The people who had bought near the top because everyone knew gold was going to 5,000 spent those years learning a tough lesson about narratives and gravity. The movie playing in 2025 has the same plot, just with updated costumes. This time, people say it is different because of tariffs and trade wars. It is different because of the size of government debt. It is different because China and Russia are adding gold to their reserves. It is different because globalization is supposedly in reverse. The characters are new, but the dialogue is painfully familiar. Take tariffs and trade tensions. The world has endured more than a few of those. Think about the Smoot-Hawley tariffs in 1930 or the Plaza Accord in 1985. They caused real dislocations, but they did not permanently alter the basic arithmetic of owning productive assets versus owning inert ones. Or consider government debt. Yes, debt levels are high today. They were also extraordinarily high in 1945, higher as a share of GDP than they are now. The United States grew, innovated, and inflated its way out of that burden while building extraordinary businesses along the way. What about central banks buying gold? It is true that many central banks have added to their gold reserves in recent years, particularly outside the West, but you need to look at the trend, not just the headline. At lower prices, gold was a minor, reasonably priced diversification strategy. At $4,000 an ounce, even central bankers understand that they are paying a huge premium for something that produces nothing. The monthly data already show that net purchases have slowed. If a major central bank ever decided to sell a meaningful chunk to support its currency or plug a fiscal hole, the psychological shock alone could rattle the market. Underneath all these arguments lies the key question almost nobody bothers to ask. What is the real upside from here, and what is the real downside? Suppose you buy gold today at $4,000 an ounce. Maybe if everything breaks just right for you, it runs to $5,000. That is a gain of 25%. Nice if it happens, but hardly life-changing. Now flip the picture. In both 1980 and 2011, gold lost roughly 40 to 60% of its value after peaking. If history rhymes, a move from 4,000 down to, say, 2,200 would not be extraordinary. That is a decline in the ballpark of 45%. So you have an asset that produces no income, depends entirely on price appreciation for its return, and offers you an upside of maybe 25% with a downside of 40 to 50%. If someone tried to sell me a business on those terms, I would smile, shake their hand, and politely decline. When I invest, I like to risk $1 to make 3, not the other way around. Now, some of you will say, all right, Warren, fine, you do not like gold, you never have, we get it, but what should we do instead? Where should we put our money in a world that feels this uncertain? That is the right question. I do not believe in telling people only what to avoid. I believe in showing them better uses for their capital. The best protection against inflation over long periods is not gold. It is ownership of businesses that can raise prices without losing customers. Think of companies that sell simple, beloved products and services, those little daily indulgences and essential utilities that people keep paying for regardless of headlines. Coca-Cola can nudge the price of a can higher, and people will still reach for it. American Express can charge fees because its cardholders value its network. A strong utility can adjust rates over time while keeping the lights on reliably. Apple can bring out a new phone that costs a bit more, and millions of people will line up anyway. These kinds of businesses generate cash year after year. They reinvest a portion of that cash into growth and return the rest to owners. Over decades, that compounding does extraordinary things. You do not get rich quickly. You get rich reliably. If you are not interested in analyzing individual companies, and many people are not, you can still own pieces of great businesses through low-cost index funds. Buying a broad index of American stocks is, in effect, buying a slice of the entire productive engine of the country. From 2000 to 2025, gold climbed from about $280 to around $4,000. That is impressive. But over those same 25 years, the S&P 500, with dividends reinvested, turned $10,000 into several times what gold would have given you. And it did so while representing ownership in companies that employ people, innovate, pay taxes, and evolve. And then there is the quiet, unglamorous choice that almost nobody on television gets excited about: short-term U.S. Treasury bills. At current interest rates, you can earn 4 to 5% a year, guaranteed by the full faith and credit of the United States government. There is no drama, no shiny metal, no parade of breathless commentators. There is just a steady, predictable stream of interest and your money back at maturity. In Berkshire Hathaway, when we hold cash, we do not hold gold. We hold Treasury bills. In 2025, those bills earned us billions of dollars in interest. Gold, had we owned it, would have earned us exactly zero while subjecting our capital to the risk of a big price drop. For people who understand it, farmland remains one of the most compelling assets on earth. I am fond of reminding people that you could trade every ounce of gold in the world for all of the farmland in the United States and still have money left over for some of the best companies. Farmland produces food, and the world is not getting any less hungry. The same piece of land that grew a certain number of bushels in 1950 grows far more today because of better seeds, better equipment, and better knowledge. That is what a productive asset looks like. It improves. It adapts. It serves human needs. Well-chosen real estate is similar. An apartment building in a growing city can provide steady rental income and appreciate as the neighborhood flourishes. A warehouse in the right location can serve the backbone of modern commerce. These are tangible assets tied to real economic activity, not speculation on what someone else might magically be willing to pay you one day. And then there is the single best investment most individuals can make: improving themselves, learning a valuable skill, building a business, becoming better at something the world needs. Those things have a way of compounding far more powerfully than any metal locked in a safe. When I was young, I did not go out and buy gold coins. I bought books. I studied under Ben Graham. I read annual reports. I started partnerships and invested in businesses. The return on that decision to invest in my own knowledge and judgment dwarfed anything I could have earned from betting on metals or currencies. Now, before we wrap this up, I want to address a couple of objections that always come my way when I speak bluntly about gold. First, people say, what if you are wrong? What if gold keeps soaring? What if we do get hyperinflation and the dollar collapses? I do not have a crystal ball, and anyone who says they do is either fooling you or fooling themselves. Could gold go to 4,500 or even 5,000 before the air comes out? Yes, that is entirely possible. Markets can stay irrational longer than you might think. Could inflation be higher than we like for a while? Yes, that too is possible. But investment is not about finding the one asset that wins under every imaginable scenario. It is about making sensible, probabilistic choices. The U.S. has faced serious inflation before. It has fought wars, endured recessions, survived political turmoil, and managed massive debts. Through it all, the people who owned productive assets, farms, factories, railroads, technology companies, came out far ahead of those who clung to unproductive hedges. True hyperinflation, the kind that destroyed currencies in Weimar Germany or Zimbabwe or Venezuela, tends to occur in places where productive capacity has collapsed, institutions have disintegrated, and the government's only remaining option is to print money to survive month to month. That is not the situation in the United States. We have problems, of course. We always do, but we also have deep capital markets, resilient institutions, and a remarkable capacity to innovate our way out of tight corners. Second, people say gold has been a store of value for 5,000 years. Are you really smarter than 5,000 years of history? I have no interest in arguing with history. Over very long stretches, gold has roughly preserved purchasing power. If you buried an ounce of gold a century ago and dug it up today, you could still trade it for roughly the same quantity of bread or suits. That is not nothing. But you have to ask, compared to what? If your great-grandfather had buried $10,000 in gold and your neighbor's great-grandfather had bought shares in a handful of well-run businesses whose family would be wealthier today, the record on that is not even close. The real danger with gold at $4,000 is not that it suddenly becomes worthless, it is that it lures people away from far better choices. Every dollar you allocate to an unproductive asset at an extreme price is a dollar you are not putting into something that can grow, adapt, and pay you back over time. That is the opportunity cost. Over 5 or 10 or 20 years, that opportunity cost becomes enormous. I have lived through more bubbles than I care to count. In each case, the script has been the same. Prices surge, the story hardens into dogma, skeptics are mocked, and latecomers rush in. Then something shifts, sometimes something obvious, sometimes something trivial, and the air goes out quickly. We saw it in tech stocks in 2000, in housing in 2007, in Bitcoin more recently. We are watching the same movie again in gold. Parabolic price increases untethered from fundamentals. Wall-to-wall bullish sentiment, a new paradigm narrative, and heavy involvement by late-arriving retail investors. Those are the four horsemen of a classic bubble. Gold in 2025 has all of them. I cannot tell you the exact day or hour the tide will turn. Maybe the trigger will be a surprisingly soft inflation report. Maybe it will be a stronger dollar as capital flows back into the United States. Maybe a major central bank will hint at selling. Maybe speculators will simply decide they have made enough and start taking profits. Whatever lights the fuse, once prices stop going up, the psychology changes with startling speed. Leverage will be the first casualty. Traders who borrowed to buy gold will receive margin calls as the price dips. They will be forced to sell into weakness, pushing prices down further. Exchange-traded funds will see outflows as momentum-chasing investors abandon ship. Retail holders, the people who told their friends at barbecues that gold was going to 10,000, will panic as their paper gains evaporate. They will sell because watching losses mount is a kind of pain most people cannot bear. Somewhere toward the end of that process, long after the cameras have moved on to the next hot thing, gold will find a bottom. That bottom will not be at a level that feels emotionally comfortable to people who bought at 4,000. It will be at a level where the mathematics of mining and the history of pricing intersect, perhaps around the cost of production plus a sane margin, perhaps lower if despair takes hold. From there, gold may again become a dull, occasionally useful diversifier for certain portfolios, but the people who rushed in during the mania will not want to hear its name. You do not have to be one of them. You are not obligated to learn this lesson the hard way. You can step aside from the stampede and ask yourself some simple questions. Does this asset produce anything? Am I buying it because I understand its economics or because the price went up recently? If the price stopped rising tomorrow, would I still be content to hold it? If the honest answers make you uncomfortable, listen to that discomfort. My advice, spoken as plainly as I know how, is this. At $4,000 an ounce, gold is not a safe harbor. It is a crowded theater with a single narrow exit. When someone yells, "Fire," not everyone is going to get out unscathed. Take your seat somewhere else, in productive businesses, in sensible real estate, in your own skills and enterprise, in simple instruments that pay you for the use of your money. Let compounding do its quiet, relentless work. I have spent more than 70 years watching markets, buying companies, and studying human behavior around money. The details change from decade to decade, but the core lesson does not. Speculation is exciting, but ownership of productive assets is what builds lasting wealth. Gold is speculation at current prices. It may shine for a while longer, but in the end, it is just a metal. Your time, your judgment, your capital, those are far too valuable to waste chasing the last act of a bubble. To see where this is heading, it helps to think in stages. Bubbles always follow the same three-act play. Act 1 is the trigger. Markets rarely turn on a giant headline. They usually turn on something that looks small at first. Maybe it is an inflation report that comes in softer than expected, showing prices rising or even dipping. Maybe it is a surprise move by the Federal Reserve, hinting that rate cuts will be slower because growth is stronger than feared. Or maybe gold simply touches $4,500 or $5,000, fails to break higher, and traders start quietly taking profits. Whatever the spark, the narrative that fueled the advance starts to fray. The confident forecasts become tentative. Prices stop climbing in a straight line. That is when the air begins to leak out, even if the balloon still looks full. Act 2 is the cascade. Once an asset that everyone thought could only go up actually goes down and stays down for a bit, psychology flips. Leveraged traders get margin calls and are forced to sell into weakness. That selling pushes prices lower, which triggers more margin calls. Exchange-traded funds, which vacuumed up money on the way up, see outflows, so they sell physical gold to meet redemptions. Retail investors who bought late with shallow conviction but big dreams watch their gains evaporate and start dumping positions just to stop the pain. Financial television pivots from celebrating record highs to asking with furrowed brows, has the gold trade gone too far? Each wave of selling feeds the next. Act 3 is the bottoming. After enough damage, boredom and disgust replace excitement. Commentators who once spoke about gold with reverence now call it dead money. The same neighbors who used to brag about their coins and bars stop mentioning them. Somewhere around that point, usually near the level where production costs and long-term ratios make sense again, gold quietly stabilizes. From there, patient, rational investors might decide to own a little as a diversifier. But the people who chased it near 4,000 will not be around. They will have sold in anger long before a new, sober equilibrium is reached. Gold is not the only shiny thing that deserves caution. Assets that share its worst traits, no cash flow, no clear intrinsic value, total dependence on the next buyer's enthusiasm, should raise similar questions. Many cryptocurrencies live in that neighborhood. They do not produce earnings, they do not represent claims on real assets, and their prices can be whipped around in a weekend by sentiment, leverage, and social media. Most tokens have neither history nor utility. When optimism fades, there is no floor except the point at which speculators simply lose interest. Gold mining shares can be even more dangerous than the metal itself. On the way up, they act like gold with a turbocharger because higher metal prices drop almost straight to the bottom line. On the way down, the same leverage works in reverse. Mining companies still have to pay workers, maintain equipment, navigate regulations, and service debts. When the price of what they dig out of the ground falls sharply, their margins shrink or vanish, and shareholders learn what financial leverage really means. In past downturns, gold miners have often fallen twice as far as gold. If all of that sounds discouraging, it should also be clarifying. You do not need these things to build a sensible, resilient portfolio. Imagine a simple plan for someone starting with $100,000 in 2026. They might put 40% into a low-cost index fund tracking the U.S. stock market. That instantly gives them ownership in thousands of businesses across many sectors. Another 30% could go into a small number of individual companies they truly understand, strong brands, durable advantages, honest management, and high returns on capital. 20% might sit in short-term treasury bills or money market funds, earning a reasonable yield while acting as a cushion and a source of future opportunity. The last 10% could go into real estate, a small business, or simply remain in the index fund if nothing attractive presents itself. It is not a flashy portfolio. It will not be featured in viral videos, but over 10 or 20 years, the odds that it builds true compounding wealth are far better than any all-in bet on an inert metal. Let me close with one example that has guided my thinking for decades. In 1972, Berkshire bought See's Candies for about $25 million. At the time, some observers thought we were overpaying for a regional candy company. See's did not look exciting. It did not have cutting-edge technology. What it had was something far more valuable: customers who loved it and were happy to pay a little more every year for the same box of chocolates because of how it made them feel. The business produced more cash than it needed to operate, and it could raise prices gradually without losing its loyal base. Over the years since, that modest purchase has generated over $2 billion in pre-tax earnings for Berkshire, while delighting generation after generation of customers and providing steady jobs to its employees. Contrast that with what would have happened if we had taken the same $25 million and bought gold. We would still own the same number of ounces. The metal would not have invented new recipes, opened new stores, or warmed anyone's heart on Valentine's Day. It would have simply sat in a vault, demanding storage costs and offering nothing in return. That, in a nutshell, is the choice investors face today. You can bet on fear and inert objects at record prices, hoping to sell to someone even more anxious later on. Or you can bet on human ingenuity, productive assets, and the quiet miracle of compounding. One path flickers with excitement for a few years and then usually ends in disappointment. The other looks boring month to month, but tends to produce results that feel astonishing when you look back over a lifetime. I know which path has served me well. I know which one I would recommend to you.